I probably had the worst upbringing possible to be an entrepreneur because I had two loving parents. I had a great education. I grew up in a loving household, had all the, background.
What is the matter with you?
Yeah, exactly.
Yeah.
Well, so what I came to find, Jerry, was, and you've probably seen this in your travels as well, the guys who really kick ass out there. And it wasn't until I had a few series of events that happened to me that really forced me to thicken up my skin and get that entrepreneurial grit that I knew I had it in me. I went through a period of time. I lost my dad. I was very close to my dad. And then I got fired from my corporate finance job. And then I was like, all right, screw corporate America. I'm going out and doing my own thing. Well, this was 2006, Jerry. I wanted to get into real estate, but then I had to learn, all these things. Then the market starts crashing and running away from me while I'm spending, 20 grand a month on advertising because I was doing wholesaling. And
and the world was on fire when you were doing that for the real estate market in 2006. Yes, fire in a good way, right?
It was fire in a good way this first couple of years, but then things changed drastically while I was still trying to get my entrepreneurial legs under me, and it was rough, but I persisted, thickened up my skin, took some lumps for sure. And then I was like, I'm not going back to corporate America. I got to figure something out here. And it was around about that time that I discovered distressed mortgage debt, which lined up well with me because I was, kind of a corporate finance guy from my training up to through my corporate life. But I had this interest in real estate, so it kind of married up those two areas of interest for me really well. So just kind of grew that business to this day, 15 years later.
Hey, everybody, just finished this great conversation with Thomas Dunkel. Tom is a real estate investor, lender. He is a really interesting, in-depth conversation about how the business world works outside of traditional banking, the commercial banks, the industrial banks. You want to do an investment, you have that, but you don't know how to get it financed. He wrote a book, The Wealth Builder's Playbook. Go check it out. Tom Dunkel, The Elite Investor's Guide to Living Life on Your Terms. The Wealth Builder's Playbook. Check out the book. Listen to the podcast. I think you're going to hear this guy knows what he's talking about. I love the conversation, and we went in depth on things that the regular person probably doesn't understand about how to make money or how money's made, and that it doesn't necessarily take bank money to go make money. Opportunities are everywhere. You got to go get them. I suggest you listen to this interview with Thomas Dunkel. Check out the podcast. All right. Welcome back, everybody, to the podcast. We got today with us Tom Dunkel. Let me tell you about him. He is a guy who has been in the entrepreneurial game for almost 30 years now, from what I can tell, and he has built 2 8-figure companies. And most importantly, and he put this in his bio and I appreciate it, he's also crashed 6 other companies, which is very important. He's raised over $50 million across multiple asset classes, and he has been part of more than $1.2 billion in deals. He's currently the managing director of Eagle Capital Investments, where he helps investors grow their wealth through operator-backed deals, and we'll explain what that means. But at his core, he's a builder, a leader, and a guy who's learned by getting punched in the mouth a few times. Just that is business 101 right there. Mike Tyson said it right when he said that everybody's got a plan till they get punched in the mouth, and that is what being an entrepreneur is all about. Off the clock, Tom's a rock band frontman and an 8-handicap golfer and someone who gives back through scholarships and veterans causes. Man, I got through that. Tom, great to have you on the show. How are you?
Hey, Jerry. It's great to be with you and all the listeners today. Appreciate the intro and looking forward to our chat today.
Yeah, this should be good. Let's start. Usually we go with the usual background. Tell us a little bit about yourself, but I want to jump ahead on that just a little bit, and I want to get to a crash. I want you to tell us just off the top, what is your worst business decision? What's if you have one decision, there's probably multiple ones. If I nailed you down and said pick the worst one, give us an idea of a type of decision you made that cost you dearly.
Oh man, I got to narrow it down to one.
You got to do one. I knew that was the case. Yep.
Yeah, I mean, so when I look back at the different businesses, Jerry, and like what's been successful and what's not been successful, to me it kind of boils down to three things that were big differences between the ones that were successful and the ones that were not. The first one's a big one, which is niche, right? So like we tried to launch a hard money lending business, right? And we're here outside Philadelphia. Philadelphia is, big market, lots of rehabs going on. We were trying to loan money to, Joe Sixpack that was fixing up a house and selling it. And that was an extremely competitive market. And then, of course, COVID comes along and like no one's allowed to talk to each other. And,
Yeah.
We had hired like a sales lady to go into town and like talk to all the contractors down there that were doing the flips and stuff. And anyway, so just going into it a very competitive area without anything that was really a solid differentiator that's going to give you, a defensible position in the market. Stupid. It was so stupid that a couple years later we decided to try it again. We screwed it up again. So we failed twice at that business. Anyway,
so let's just back up to people who may not know what hard money is and what that looks like and why that would be. Again, in a competitive environment, it's almost a race to the bottom on points and on the interest rate. But most people don't understand. I'm sure what you're talking about rehabs and remodels, where a good portion of that money comes from. So explain to everybody so they know what a hard money lender is.
Sure, of course. Yeah. So, if you think about, Joe Sixpack, who's, they're buying a house at a discount, they're going to fix it up, they're going to redo the kitchens and the bathrooms and whatever, and they're going to sell it. Well, for them to buy that property at a proper discount that will allow them to fix the property and make a profit, with all the carrying costs and whatnot, they have to buy it at a deep discount. So how do you buy a house at a deep discount? Well, you got to buy it with cash and you got to buy it quick with like minimal contingencies, right? So if anyone out there has ever sold a house, sometimes, when you throw your house up for sale, like that first offer or two might be, below your asking price, depending on, of course, where you're at. And that's because someone's coming in, they're trying to do a quick transaction, hoping that you'll take a discount. Well, there's a lot of situations where a home seller is happy to take a discount. They don't have the money to do the repairs. They don't have, they inherited the property. They don't want it. Anyway, I could go on and on. Mm-hmm. So Joe Sixpack, right, having fast money is a competitive advantage for them. And so as a result, they can't go to their bank, right? Have you tried to get a bank loan recently? It's like, you're looking at like a, 2-3 month process, right? Well, that doesn't work in this world of buying and flipping houses. So those contractors, even if they have a solid business and they're credit-worthy people, they prefer taking the fast money, even if they have to pay more for it. So that's why they call it hard money, because typically the rates, instead of going to your bank and getting a first mortgage for 7% or whatever it is today, these guys are paying 12% and a couple of points, and you might say, wow, that's a huge difference, but for them, it's just another cost line item in their analysis when they're looking at these properties. So it's, drywall, lumber, plumbing, and money. And so, those are their main costs. And then, they just plug that in their model. They know if they're experienced, they know how long they're going to be holding the property. And then, they're going to be able to just calculate that in and make sure they're hitting their profit numbers. So there's lenders out there like our company that failed, that are catering to this type of real estate investor, this flipper. And so they have private money. It's typically either like we were lending out our own money. There are folks out there who are raising funds from private investors to then deploy that capital into these kinds of loans. So what I like about it as an investor is you're secured in first position on a piece of real estate. So it's a hard asset. It's not going to zero. And you're getting, typically we work it in where we get monthly interest payments. So you're being the bank. which is a great place to be. You're secured by real estate. You're getting the interest payments. It's a pretty short-term loan, so when the property sells, you're getting that capital back. And then the guys in this space that we like to work with, because even though the business part didn't work out, I still do some of this just on my own. They always have another deal coming up. So even when I get paid back, I have another deal where I can jump right back in. So it's a great cash flow investment. It's a great capital preservation investment, and that's why we like it. And that's why a lot of debt funds have popped up in the last couple of years as banks have sort of backed away from this kind of lending. It's created a void in the marketplace. So it's, as an investor, I like it. It's something that really helps to drive that cash flow component of my personal portfolio.
Yeah, we need to start a campaign to change the name from hard money lending. We need to come up with something better, because whenever I bring up hard money lending, that's usually my answer to people who go, "Oh, you got to be rich to make money, and you got to have money to get money." I'm like, no, you don't. Well, how's that work? I said, I'll give you one example, and I start with hard money lending, and they immediately think title loans and things of that nature. And I said, no, you don't understand the game, and just to give some perspective to it, as someone who has done this over, I've remodeled I don't know how many houses over my lifetime, and have used hard money, particularly in the earlier days, to do that. It is, the nice part about it is many times it'll be interest deferred. And so you're paying, you're not paying, you would swoop in, you put the money down, we buy the property, you get the house done, it's finished, it's sold, you get your money, I get mine. And I'm not feeding that loan over the course of the 2-3 months, however long it takes. And the other good thing about it too, as being somebody on the other side now that has done it from the other side, is that it aligns the lender's objection, or it aligns the person getting the loan, what they want done, and the guy lending the money, what he wants done, is aligned perfectly. Everybody wants it done as quickly as it can get done, and it really incentivizes the person taking that loan to get that work done. So it is a legit financing option. It just needs a better name.
Private lending.
Yeah, private lending. Yep.
Private lending, or flipper loan, flipper finance, something like that.
Right. Hard money always made me, somebody's going to come bust my knuckles or something. Yeah. All right. So we'll get back to that. I got one more question on that, but let's come to just give us an idea on your background. Give us where did little Tom grow up, and how did you end up where you are being an entrepreneur?
Yeah, sure. So, I probably had the worst upbringing possible to be an entrepreneur, because I had two loving parents. I had a great education. I grew up in a loving household, had all the, background.
What is the matter with you?
Yeah, exactly.
Yeah.
Well, so what I came to find, Jerry, was, and you've probably seen this in your travels as well, the guys who really kick ass out there, they came from horrible background. They lived in their car. They were, crack at. They had all kinds of bad stuff. So they built up a tolerance and a thick skin at a younger age. And so I had this great upbringing, a great education. Got out of business school, started doing mergers and acquisitions in the aerospace industry, and so I was cruising along really well. And ultimately became a vice president at a publicly traded company. The stock options, the salary, the bonuses, the golden handcuffs, all of that. And it wasn't until I had a few series of events that happened to me that really forced me to thicken up my skin and get that entrepreneurial grit that I knew I had it in me. It's just I didn't really have reason to kind of come out with it until I went through a period of time. I lost my dad. I was very close to my dad, and then I got fired from my corporate finance job, and then I was like, all right, screw corporate America. I'm going out and doing my own thing. Well, this was 2006, Jerry. I wanted to get into real estate, so those first couple years, was trying to figure out how to be an entrepreneur, how to build a team, how to run a business. And then, honestly, to that point, the only house I had purchased was the one that I lived in. So I wasn't really, doing a lot of residential real estate deals, even though the M&A was a great background for understanding how deals worked, and the debt and the equity, and putting the models together and the projections and selling the deal. So I had all that. But But then I had to learn, all these things. Then the market starts crashing and running away from me while I'm spending, 20 grand a month on advertising because I was doing wholesaling, trying to buy those houses for cheap, like Joe Sixpack. And
and the world was on fire when you were doing that for the real estate market in 2006. Yes, fire in a good way. Right.
It was fire in a good way those first couple of years, but then things changed drastically while I was still trying to get my entrepreneurial legs under me, and it was rough, but I persisted, thickened up my skin, took some lumps for sure, and then I was like, I'm not going back to corporate America. I got to figure something out here, and it was around about that time that I discovered distressed mortgage debt, which lined up well with me because I was, kind of a corporate finance guy from my training up to through my corporate life, but I had this interest in real estate, so it kind of married up those two areas of interest for me really well. So just kind of, grew that business to this day, 15 years later.
And that probably was, I know a lot of guys that did that pivot, if you will, into distressed debt following 2008, 2010 in particular, where they really went nuts because we saw, a pretty quick rebound coming out of that, and a lot of people did very well. I remember buying a $1 million house for 440 grand, on the steps of the courthouse,
nice.
and other deals just like that, where banks were just trying to get rid of that bad debt as quick as they could. So, so then coming forward then, and that was going to be my next question, kind of that's the background, and today you're essentially doing that same thing, and that is what you've done, raising money to essentially go out and buy distressed debt? Yeah,
so that's been our primary business. We'll put it that way. And so the growth of that business, and we were an 8-year overnight success story.
Yeah, right? Isn't everybody right?
So I partnered up with my partner Joe Downs in 2010, as you mentioned, and that was a good year to kind of get started with it. And we sort of battled our way through, make a name for ourselves. Eventually got to a point where we were buying direct from a big bank. So that was sort of a game changer for us. But now 15 years later, this success of this business, which has now generated over $63 million of revenue, has allowed us to try these other things. So it allowed us to make stupid mistakes in the hard money lending business. We were partners in a title company for a little while, and then one of our partners just went, kind of loco, and so we had to get out of that. And then we've done okay in self-storage. We have a self-storage company. We've picked up about $55 million worth of self-storage assets. And then we also have a short-term rental business that's it's gone pretty well. But basically we're using this distressed mortgage debt business, which is called U.S. Mortgage Resolution, as sort of an engine to allow us to diversify into other asset classes, other areas within the kind of in and around real estate.
And to that, again, we'll go on with distressed debt just to make sure that everybody, sometimes, you've been around the block a while, and so have I, and we throw the terminology around, and I forget that not people are interested and fascinated in how these things work, but they don't know the jargon. So let's give us an idea, run us through a deal that you've done, a distressed debt deal that would make sense to everybody so they know what we're talking about.
Sure, yeah, it's pretty simple. If you just need to start thinking like a bank instead of a consumer, instead of a borrower. So let's say there's a borrower takes out a mortgage on their house. They buy a house for $400 grand, they get a mortgage for $300 grand, and then life happens. They lose a job. There's a health issue. There's a family issue. There's something. I mean, we've heard it all, right? Mm-hmm. So sadly, they end up not being able to make their mortgage payment, right? So Big Bank USA, they're not equipped to really handle that situation very well. They're not entrepreneurial. Their box of understanding is about yay big, right? They're like, oh, you can't make payments? Well, forget it. And because a lot of times these borrowers, they'll go through this problem And then they come out the other side and they call the bank and they say, hey, I'm back on my feet. I'm through the issue. I just want to start making my payments again. And the bank will say to them, well, you've got this, $30,000 of arrears that you haven't paid the last couple of years. So you need to catch that up first, and then you can start making payments. Like, what? It makes no sense. So these banks, they just can't think, they can't get out of their own way. So what ends up happening, because banks are highly regulated, right? So the regulators come along every maybe quarterly or so, and they look at the balance sheet of the bank and they say, hey, you've got these loans that aren't paying. They're called non-accrual loans, and the regulator says, you got to clean that up, right? Because we can't have the bank being unhealthy. So to clean that up, the bank will sell those loans out into the world, and a company like mine, U.S. Mortgage Resolution, would bid on them. We'll do our due diligence. We'll run the numbers, we'll do the projections, and we make a bid, and we acquire those loans at a discount, right? So these are non-performing loans. NPLs is what they're called. So a non-performing loan isn't a $300,000 loan isn't going to sell for $300,000 because it's banged up, right?
Right.
So we'll buy it at a deep discount. So when we first started, as I mentioned, we were buying from intermediaries. So we were paying, more because that middleman needs to make a profit too. But now that we've shifted, this is going back several years now, maybe 10 years, we're buying directly from the bank. Now we're getting a big discount. And so that gives us a lot of flexibility, right? So if let's say the face rate on that mortgage was 8%, 7%, whatever it was. Well, if I buy that loan for 50%, if I buy that $300,000 loan for $150,000, then my yield is going to be 14%, right? Because I'm buying a 7% loan at half the price, half the balance. Mm-hmm. So if you follow my math there. So
yep.
We actually specialize, speaking of a niche, right? And I think that's one of the reasons why U.S. Mortgage Resolution has been so successful, is our niche is what they call charged off second mortgages. So these are home equity lines or term loans that are in second position. So as soon as someone hears second position, they're like, what? Oh, that can't be worth very much. So the market really starts to thin out, and that industry gets very, very nichey. So we don't get a lot of competition, and so that $300,000 loan, we might buy it for $30,000. So that allows us a lot of wiggle room to work with the borrower. Because last thing we want to do, Jerry, is we don't want the house. There are companies out there they'll buy the loan so they can foreclose and get to the house. To us, that's kind of a lose-lose, right? We don't want to put someone out of their house if they want to stay. And it's expensive, it takes a lot of time. So we end up reaching out to the borrower and saying, hey, we ask them 3 questions. What happened? Where are you now? And what do you want to do? So it's, what happened? Well, I had a health issue. I was in the hospital for a year or so, something bad happened. And I fell behind on my payments. Well, where are you now? Well, I'm over the health issue. I'm back to work. My income's back where it was before. Well, okay, so what do you want to do? Well, I want to keep the house. Okay, great. So we'll work with the borrower through the workout process so that we can get them back on a loan modification. So basically taking the terms of the original loan and really adjusting it to their current financial reality. So maybe they were making more money before their illness and now they're making less money. So that $1,000 a month payment, maybe they can only afford to pay $750. Well, that's a win for them, and it's a win for us because we're buying at such a discount. And so we have a lot of, like I said, we have a lot of flexibility to work with the borrower to come to a solution. Some of them just want to pay off at a discount. So if it's a $300,000 loan that we bought for $30,000 and they're willing to pay it off for $100,000, is that a win for everybody?
Yeah, for sure.
So that's kind of the distressed mortgage debt world in a nutshell.
On the workout, what's your exit strategy when they're doing a mortgage, when they're redoing the mortgage and they say, okay, I'll pay you the $750? How do you get out of that? How do you get your money back?
Yeah, great question. So I guess we have a couple of options, right? Number one is, by the way, we're happy to sit on the cash flow. So we've actually built up a nice portfolio of reperforming loans to the point where, it's paying for everything.
Right.
Pays us nice salaries, pays our staff, pays for our rent, pays for this, pays for that. So, and that's just money coming in. But what they can do is once they go into default, right, their credit score is trashed, right? So they can't refi, they can't do this, can't do that. But once we get them back on that loan modification program, their credit score starts to increase, and they can work towards a refinance of the property, in which case we would get paid off, and they get a new loan, and then they're off in the world, and we're finished with that borrower. Sometimes these guys, they can take a hardship withdrawal from a 401k. They can go to a family member that might have some extra money and do a discounted payoff. So paying off the $300,000 loan for $100,000, they can try to work it that way. Or ultimately, some people might just sell. They might sell the house. In which case, we get a decent number of full payoffs. So that $300,000 loan, we'll get the full $300,000. But typically in our world, we're giving some kind of discount somewhere along the line.
Yeah, and that's good for everybody. Explain to people why, in the scenario you just laid out, $300,000 house, you bought the loan for $30,000, you lower the payment from $1,000 to $750. Mm-hmm. Somebody's going to look at this and see the numbers that you're moving and look at that and go, well, who in the hell would take $750 a month? How is that a good deal? Explain to the folks why that's a good deal.
Sure. Well, $750 a month times 12 divided by 30,000. I mean, that's a very high yielding stream of cash flow, right? And so that's one of the strategic shifts we made in our business about 6-7 years ago, was to work on building up our portfolio of reperforming loans. Because up to then we were really a lot more transactional. Because we had investors and we wanted to pay the investors back, and so, but it's really a high performing, it's a high yielding income stream, and what is it, the eighth wonder of the world, Jerry?
Yes, right.
Compound interest.
Compounding interest, and so just to put a number to that thing, roughly what he's talking about, what Tom's saying is, he's investing $30,000 to make roughly $10,000 a year. So who among us would not put in $30,000? Lay out $30,000. It's guaranteed with the equity, with the value of a house that's worth $300,000, and he's making $10,000 on his $30,000. I know a lot of people would jump all over that. It's not free. It's not easy. There's risk involved in all of that. But just to give that give people a good idea on what your return can be. Now and you don't have to comment on this if you don't want to, because I know you have banking customers, but. I'm not a big fan of banks generally, and it gets worse and worse, particularly post 2008, 2010, too big to fail, and now they're all 2-3 times bigger than they were. I hate that guys like you have to exist anyway, only from the sense that we need more community banks. We need smaller local guys in the neighborhoods that are doing these kind of loans and that you can go to, and the bank could have a part in this and could play a part rather than selling it for pennies on the dollar. I'm happy for you. Don't get me wrong.
Sure.
But you hit it on the head with all the regulation and everything. And I anytime I get the opportunity for regular folks who may not understand, I always talk about banks as the enemy, which I believe that they are because of the regulation, and really it all goes to the biggest. As much as you want to comment on that, I don't want to put you in a corner though. But I wish there were more local banks that just did what you're talking about the way they used to.
Sure. I mean, honestly, Jerry, for better or worse, our U.S. mortgage resolution business, it has been around for so long because of how screwed up the big banks are. Like, the big bank that we buy from, like, they'll send us we call it a tape, right? Because back in the old days, they used to come on the big magnetic discs, the big magnetic tapes. But they'll send us an Excel spreadsheet of the loans they're looking to sell to us. And we'll go through it with our due diligence process that we've developed over all these years. And now it's kind of cool. We're starting to use AI agents to help us with our their due diligence. Anyway, it's maybe a topic for another day.
Yeah.
But they have no idea what is happening with this pool of loans that they're looking to sell to us. Like our due diligence, and it's not like we're the greatest due diligence company on the planet. I don't know, maybe we're one of the better ones, but these banks, they don't know, the left hand doesn't know what the right hand's doing, and so it creates these problems. And like I said earlier, their box when they're talking to a borrower is so small, and they're just basically handing us the ability to make that,
Right.
30 some odd % cash on cash with that loan example we did a minute ago.
Rather than being flexible and just doing that themselves, rather than losing the $150,000, $200,000, $270,000 in your example, writing that off, they just do that themselves. Or again, I know that's simplistic, but it's one of the many ways that I abhor the system that we found ourselves in, because it was supposed to be better after 2008, 9, 10, and it's just gotten inexorably worse, I think.
I don't disagree at all. In fact, in our storage business, Belrose Storage Group, we're doing deals where we're buying facilities between maybe $2 million and $6 million, so that a little on the smaller side, and we get the best execution on those loans from the small banks, from the community banks, and they're like a joy to work with comparatively.
Right. Yeah, bring that neighborhood bank back, like there is so many. But people, I don't think people understand, and I preach about it all the time, that you just can't. That you just inherently aren't able to do that. The government won't let you. So. No. And they control all of that. Talk about then. Let's go back to Philadelphia as an entrepreneur. With all the experience that you have now under your belt, you go into the lending program in Philadelphia. It doesn't work. You back out. COVID hits, all the rest of that. Was it a different, what put you back in there, and how did you think you could win? And I'm asking the question, I talk about when we get successful, I talk to entrepreneurs all the time that when I was at my most vulnerable, when I cost myself the most money, is when I was making the most money. I made the worst business deal of my career the month after I had the biggest month of my career, revenue or income-wise, profit-wise.
Right.
And so, you get to that point, and all of a sudden the business is doing $20 million a year, and I'm making hundreds of thousands of dollars a month, and life can do, but what I didn't realize is I was leaving 30, 40 grand on the table every month, right? Because I was so satisfied with this number. And I made a deal because all of a sudden I thought I was God because I was making all of this money, forgot a bunch of the rules and the reasons I got where I was. So I'm asking from that perspective. I don't know if your situation was the same, but what if it was such a loser a couple of years before, what drew you back in, and then what happened that time?
Yeah, so... actually, the COVID time, that was actually the second time. The first time was, I think, maybe 2015, 2016. But, I guess it brings me to maybe the second key thing that I find separates good businesses from failing businesses. So the first one was niche, which we talked about earlier. The second one is team. So the first time we tried the hard money business, we had a guy who's kind of a friend of ours, and he was looking for something to do. We're like, hey, why don't you, and he was, had kind of a sales background kind of thing. We're like, oh, well, you'd be good for going out and chatting up, title companies or whatever, and going and doing this and that. Well, we didn't really go through a hiring process. We didn't really go through and say, hey, this is the type of person that we really need for this role, and go and look for that person. It was more like this guy fell in our laps. We liked him because, we were friends with him and hung out and stuff. We're like, oh, well, we'll just let him run with it. This will be great, And of course, you know how the story ends, he doesn't really perform, and then we're busy doing other things where he was supposed to be, kind of pushing that business along, and so it just never really got to where it could have been. And then the second time we tried it, in 2021, we thought we did have the team. Like I said, we did go through a hiring process. We hired a girl who, frankly, we thought would get the attention of the contractors who were looking to borrow the money. And then, COVID hit, and she was like, I'm not going down there. I'm not going to talk to people. And then, then all the other craziness associated with COVID was happening. We're like, okay, let's, but we did push through. We made some loans. We brought in some partners, and now, again, because I think the team wasn't really very strong, and we weren't very disciplined in that particular niche. Well, it wasn't very nichey, but in that particular area, shall we say, we made some loans we probably shouldn't have made, and now because we were, pushing to kind of get capital deployed, and then now, fast forward to today, I think we still have a handful of loans that we're like working through, like the workout process and the foreclosure process in some instances. So yeah, you gotta make sure you have that team buttoned up, and don't hire your buddy because you like hanging out with him.
I will two things on that. What you just said. One is on capital deployed. It's important for people to understand that you're not making money if you're sitting with money in the bank. You have your reserves, all of that, but your capital that you have that is designated to be out on the street, as they say, needs to be out on the street. And if you don't have somebody to, I think people find it hard to believe that it would be hard to loan money. It's not hard to loan money. I say it's like sales. Sales are easy. Selling profitably is hard. Loaning money is easy. Finding good loans to make.
That's right.
That's where it gets difficult.
Yeah.
Well, the other thing that you said with the friends, I tell new entrepreneurs all of the time that I'm not sure that anybody needs a partner. And I know you have a partner, so I want to get your feedback on this. In my experience, so many times we get partners because it's more convenient at the beginning, right? Where we get to commiserate with somebody, we get to share the risk. The families are connected, and you get 4 or 5 months down the road or a year down the road, and you start making money, and all of a sudden one partner looks at the other partner and says, "Oh man, I think I could have done all of this without him." And then ultimately once money gets involved and money is being made, everybody's happy when money's being lost and the fight is on. Once money gets made, I've seen so many of those things fall apart, and that was my experience also. What's your take, on family or friends? You just elucidated that. What's your take on partners?
Yeah, it's a great question, because my first business, when I got fired from corporate America and I jumped into real estate, I was like, I don't need a partner, I can do this myself. I've got the great background. I know how to do deals. I bought into a system, so I knew I had like the system in place with the marketing and the this and the that. And then after that, after that experience, which was very challenging those next few years during the Great Recession, I was out, networking, going to the real estate networking events, and I ran into a guy. Turned out we lived in the same neighborhood, and he lived over here, I lived over here. There was a bar right here, and so we decided we were going to meet up at the bar like a week later just to kind of talk some more, because he was looking kind of for his next move. I was looking for my next move after the residential real estate market crapped out, and we just kind of hit it off. I think we hit it off on a kind of a values, at a kind of a values level, because he was married, he had young kids, I was married, my kids were a little older than his, but anyway, we sort of had those similar values. We were from the same area, had some mutual friends and things like that, and he had some skills that I didn't have, and I have some skills that he didn't have. And so it just seemed to marry up well in that regard. So it's worked out for us. Now, when we have brought in other partner-like relationships, like with the hard money lending and with this and with that, we probably didn't do like the same kind of, mind meld, if you will, with those folks. And so I think that's why that failed. But I think Joe and I have now been partners over 15 years, and it's like any other relationship, hasn't been fantastic the whole time. But net, like that bedrock of values is still the same, and so the skills complements are still there. So I think that's what's allowed us to be successful.
You have raised, it said in your bio, over $50 million across different asset classes. And when you are raising that money, two questions there. Number one, who do you raise it from? I'm assuming private individuals, but you can tell us how you do that. And when you're figuring out what the right deal is to do with that money, how are you evaluating that? And to what extent do you add in a gamble, a risk, or a higher return for a little bit more risk? There's two questions in there, so we'll go with the first one first. Where people hear that all the time. I went out and I raised X. What are you doing to raise X?
Yeah. So when U.S. mortgage resolution started growing and started buying bigger and bigger pools, the first deal we did, Jerry, we scraped together between the two of us $12,000, and we bought 6 loans. And then, we had we worked those loans ourselves. We did some workouts with the borrowers, and so we had some stories, right? And so when the next opportunity came up, we were like, well, we need to go raise some money for that, but we have some stories. Let's go share our stories about what we're doing with these potential investors. And then, so we bought a $200,000 pool, and then after that we bought a $750,000 pool. And so we ended up, reaching out to, first it was like friends and family, right? So it was successful people who were in our world, we were on our network. So for example, my partner Joe, he had a buddy that was killing it on Wall Street, right? So we went to his buddy and we basically did like a mini roadshow up in New York City, and we just sort of hit kind of the friends and family, they call it, right?
Right.
By the way, can you hear me okay? It's a little...
Yeah, I got the truck in the background, but you're all right. Yeah. We can hear you. Yep.
Okay, I can close the window if you want.
Yeah, that'd be better if you could.
Okay, one second.
All right. I'll just make a note right there. They'll edit that out. No problem.
Yeah. Sorry about that.
No problem.
So the first go around was really friends and family, people who were in our warm little circle, and then like their friends, and so it sort of have those concentric circles. So the first like 30 million that we raised was really that way, because through that process we ended up finding a couple of big fish, a couple of 9-figure net worth type guys who we did start out small with them, but then we were able to go to them as after that trust was built up and we performed, then they were basically just ready for whatever deal we ran across. Now, what we did wrong during that process was we only raised money when we had a deal. And so as a result, we kind of put ourselves in a tough negotiating position, right?
Right.
In other words, we had no leverage. It's like,
right.
We have to close this deal. So those first, the first group of guys, like, they would beat us up on terms pretty good. And so, but we didn't have a choice. So we would do the deals, get the deals done, and grow the business. And we kind of did what we had to do at that time. Well, when we decided to launch the storage business in 2019, we said, okay, let's not make that mistake again.
Right.
So we organized the company such that I was the chief investment officer, and what I was charged with doing was raising the capital, getting the money in, the debt and the equity, so that we could close on these self-storage transactions. So we took a little different approach, which was, let's raise money all the time. At least, tee up the investors along the way, so that when a deal does come along, we can put it out to our list of investors, and hopefully it'll be oversubscribed. And so that way, we kind of regain some of the negotiating leverage. And so that's kind of how that works. So these are accredited investors, which means they make $200,000 a year if they're single, $300,000 or more if they're married, or they have $1 million of net worth, not including their primary residence. So so there are people who have some wherewithal, and I guess the government looks at that as, because this is all driven by the Securities and Exchange Commission.
The most arbitrary set of rules. I know a lot of poor $200,000 a year guys.
Yeah.
Yeah.
Yes.
Yeah. It's just
Totally.
so arbitrary.
Yeah.
Right.
Very arbitrary.
Yeah.
But we were able to grow. So we were able to raise $20 million of equity for our self-storage business while we were getting that going. So.
And so when you're doing that, are you guys? What's the goal for you? Are you doing the 2 and 20 program, or are you functionally in every single deal with your own equity, looking for your side to come out when you sell it? What's your managing? What's the profit side of it for you guys?
Sure. Yeah. So that in that business, in the Belrose Storage Group business, we would make an acquisition fee. So we'd make a fee for putting the deal together. So that was one stream of income for us. But really, the biggest part was a profit split on the back end. So that really aligned our interests with our investors, because we have to hit a certain hurdle return before we can really get paid the way we want to get we want to get paid for that deal. So there would be like payments made to investors along the way out of the cash flow, and then at the end, when we improve the operations and we increase the value of the property, then we would sell it, return capital to the investors, and then we would share in the leftover profit. And so that was really the bucket of money that we were focused on as a GP, as a general partner kind of model, with the investors being limited partners, meaning they're just capital partners. They don't have any say in the operations. So that was really how those deals are structured and set up. So it's kind of a win-win, right? So if a lot of our investors are, they might be busy business owners themselves, or high achievers, lawyers, consultants, engineers, they're out doing their thing, right? But they invest with us so that they can get some passive income and get some exposure to asset classes outside of the public markets, the stocks, bonds, and mutual funds. And so they can get exposure to real estate, they can get the depreciation deduction on their taxes and all that good stuff without having to get their hands dirty, without having to find the deal, run the deal, sell the deal, all that. They can do what they are good at and invest with us and let us do what we're good at, and so it's kind of a win-win in that regard.
There's another term right there that you use that is probably the only true definition of that term, and that is passive income. Social media is inundated with a bunch of entrepreneurs who stand in front of Lamborghinis they saw parked on the side of the road and start talking about passive income, and you too can make $10,000 a week working 4 minutes a day, all of those, and that seems to be 90-odd% of entrepreneurial advice given on the internet. But that, and I always argue back about anybody trying to grow in rental houses and all the passive income's a joke, and you're going to work as hard on that as you will on anything else. But on your model, that's once you've made it, you have distributable money sitting in the bank that you want to place somewhere. You give it to a guy like you, and then you just sit back and trust you to go do the job. Certainly, you are accountable to your investors and things of that nature. But from an investor side, that's probably where that term came from, and then it's been bastardized outside of essentially what you're doing with their money.
Yeah. There's certainly a lot of noise out there, and really, to be honest, Jerry, I feel like that's kind of the value that I bring to the marketplace is I allow those busy property owners, busy business owners who don't have time to go out and find the multifamily operator or the self-storage operator or the medical office guy, but that's what I do. So they can trust in the network that I've built over my long career doing this, and they can tag along with me, because guess what? I'm invested in that deal. I never bring a deal to my investor partners that I'm not putting my own money into myself. So they have the benefit of getting tapped into my network of curated operators in these different asset classes, and just my experience in doing the due diligence. Right. So I have a proprietary due diligence method I've developed over the years called the safe investing method. SAFE. It's investing isn't safe, so don't come to me and say,
Right,
hey, you said it
right.
was safe. But SAFE is an acronym, which basically means you gotta check out the sponsor, you gotta know what asset you're investing in, you gotta understand the financials and the exit strategy. That's the SAFE method in about 5 seconds.
Right.
But yeah.
So are you? There's a lot of hands in the cookie jar at that point upon exit. But for you, is it a strategy that a small piece of something big is better than a big piece of something small, rather than just do those deals yourself, particularly as profitable as these things can be?
Sure. I mean, as a younger man, I might have said, "Hey, I'm going to take this down myself."
Yeah.
But, these days, Jerry, I don't know about you, but I'm looking to spend a little more time on the golf course and at the beach, and playing with my band. I'm newly married, and so my attention is wanting to be not 100% in every deal all the time. So that's where I'm looking at building my own passive income again, and where my network of investor partners can kind of tap into what I'm doing and take advantage of the knowledge and experience that I have in that network.
With that collateral base, and as long as the deal is bought correctly, for a while there in 2011, 12, the margin started to shrink significantly. I noticed come about 2012, and by 2013 we were roaring again back the other way. And so there was that small window where deals could really be bought that just essentially guaranteed you a pretty good return. In that world, are you just trying to how do I want to say this? You're looking for the best deal possible without the gamble. Sometimes in the gamble, there is more money to be made, but again, it comes with hair on it, right? The deal is a little bit more risky. What's your approach to that?
So, I guess it comes down to a few things. So, as an investor, like, where are you in your investing career? If you're a younger person, like my son's 23, right? He's excited about investing. He's getting into it. He has a long time horizon to invest, make mistakes, but he has time to fix them. I'm coming up on 58 years old. I've got some wealth accumulated. I'm more interested in this at this point in capital preservation and some cash flow. And if I can get some tax advantages, that's awesome as well. I'm not really looking for the home run, growth play. But that being said, I think, even at my stage, like, there is some diversification that needs to happen, not only in asset classes and geography, but also the type of deal it is, the risk profile of the deal. So so I put some money, which I can afford to lose, into a tech startup in the real estate space. So I'm looking at that as either a zero or it's going to be like a 10,
home run.
10, 20x. But if it goes to zero, it's not gonna hurt my lifestyle, right? So it was a guy that I know, like, and trust is running that deal, and so I figured, okay, let me drop a few bucks there. But as far as my day-to-day wealth building, cash flow building, I'm looking at just more stable, like I said, capital preservation kinds of deals that are throwing off some cash flow. So like I said, I can spend some more time on the golf course and at the beach.
So the riskier ones, we'll leave those to the other guys. You're looking for the more sure thing, maybe a bit smaller margin on it, but less headache.
That's right.
Yeah, I like it. So you talked about building teams that don't suck. And I don't disagree with that at all. Give us an idea on what that might be to figure out whether or not that person that you're looking to hire and it doesn't suck, and then what it can mean when you find one that's a keeper and you bring him in, which it sounds like you have with your team.
Yeah. I guess as I touched on this a little earlier, but the key thing is don't go for that easy hire, like the guy, like your buddy who maybe you play golf with, or you know him from somewhere socially, and you're like, oh well, he seems pretty successful, and he's got some skills, and hey, do you want to help us out with this new thing that we're don't do that. Even though it's easy, it's comfortable, right?
Right.
So you got to do the uncomfortable things. You got to go through the process. And so the first step is really looking at your overall business and determining like what are the key areas of accountability that are in your business that are going to help you get from here to there. And then once you identify those areas of accountability, then it's okay. What does that person look like that is going to be the best for that area of accountability, and be specific about what that job description is. What do you need as a business owner out of that person? And then culturally, right? You want them as you're vetting people. You want to make sure your core values line up. You want to make sure that they understand the purpose of your company, what you're trying to do, and then a lot of people might self-select out as you're out looking for candidates because maybe their values don't line up or whatever it is. But in the interviewing process, which I would say you need to have people interview multiple times with multiple people in your organization.
Right.
But in that interview process, really ask a lot of questions that are drilling into those core values. So that you have before, you need to have those before you go out looking for people. So the core values, the job description, and then the interview process. And interview in like different places. Don't just interview them in your office 5 times. Interview them in your office once. Meet them at a coffee shop another time. Depending on the business, but depending on the role that they're applying for, maybe meet them in a more social environment, maybe on the golf course or something like that. Meet them in different places, and so for example, like at a restaurant, if they're chatting you up and they're super nice to you, but they treat the wait staff like crap.
Yeah, good point.
Like that's because right, it never gets better than the interview. People come in the interview like they know they got their best suit on and they're in their best behavior, but you want to see how they react in different environments, and then like I said, then eventually get that mind meld, and then that it's going to be a good fit.
You're investing your time to try to get to know them. So rather than just via the interview, you're doing your best to really get a sense of where they are. That's a good point, and I like the analogy there at the restaurant. And get a look at, do they look people in the eye? Do they say please and thank you? It's the small things.
That's right.
Yeah,
for sure.
One more question for you. So you're a musician. So well, it's going to be multiple questions about hobbies. So you're a musician. Tell us about that.
Yeah, actually had a gig last night. It was a lot of fun. My dad was a musical. I mentioned him earlier. He was a piano player. So I started playing piano as a young kid, picked up guitar when I was about 11. Played in like the garage band in high school. We'd steal bottles of booze from our parents and go down the basement and jam and and so that was just a blast, right? We had so much fun. We actually sounded pretty decent. We played in the high school and the talent shows and the lunch munches, and when somebody had a party in the neighborhood or whatever, we'd go over there. And then all that ended when we graduated from high school, kind of went our different ways. And I played a little bit in college, just myself on an acoustic guitar. And then, now fast forward to today, my kids are out of the house, right? My son's graduated college. My daughters, 2 daughters are juniors in college. So now I got some time, right?
Right.
And I have a business that's basically running itself. So I don't spend a lot of time running the business. So I decided about a couple of years ago, I learned through a friend of mine who's a guitar player that I could hook up with a local music school, basically called School of Rock. I don't know, maybe there's franchises out where you are. So they have an adult jam night on Tuesday nights, and so I decided, well, let me go check it out. And then now here we are 2 years later. We're sounding pretty good. We've played out at different music venues a handful of times now, and it's pretty fun. It gives me a creative outlet, musical outlet, and it's challenging. It's definitely as new songs come up, I have to learn them, and I do a lot of the lead singing. So I gotta make sure I'm, keeping the audience engaged with a little bit of a show up there and the banter in between songs and all that. So
that's a great release and a great therapy. I'm sure golf is the same way. I know I'm a pool player, and so I love to play pool. And I talk about, I play in these leagues, and I'm always fascinated at how competitive, not that I don't want to win, but it's like, guys, it's Tuesday night and nobody's getting paid and we all have to go to work in the morning. Let's enjoy what we're doing here and kind of relax. And so pool for me is probably the same thing as what you're doing there, which is awesome. It gives you a chance to get out of the way and forget about what you're doing at the office or whatever might have happened during the day and just kind of relax. And I think that's important for entrepreneurs.
100%. Yeah, you need to have those things that you're doing outside of work, like and as a golfer, right? Like I meet some really interesting people on the golf course, and sometimes they end up becoming investors, which is great. It's not the not the main thing, but sometimes they do. It's just a great way to get your mind off other things, and a discipline like golf or a discipline like playing a guitar or running the pool table. Those are all good things to just kind of keep your mind. You don't want to be a one-trick pony. You don't want to get stuck in a rut. You need to, get some energy from some other places.
Piece of advice you would give new entrepreneurs out there, or ones that are looking, let's say they're young and struggling, or they're looking to become an entrepreneur as we go out here. Give them one piece of advice you kind of are different, that you came out of the corporate side, but you still struggled when you became an entrepreneur. Maybe let me ask that question differently in that context. What was the thing that kind of hit you in the face that you thought, I came out of the corporate world and now I'm going to go into an entrepreneurial world? And what was like this is different. This isn't the same program.
Yeah, so there's a book out there. It's been years since I read it, but it's called, You Can't Learn to Ride a Bike at a Seminar, or something like that. So, get the education, go to the networking events, go learn from people who are doing what you want to be doing. But ultimately, man, you got to do it, so you got to go and do it. So like for me, like I had been wanting to do something entrepreneurial. And so, but like I said at the very beginning, I had the golden handcuffs, I had the salary and the benefits and the bonuses and the stock options and all this stuff made it hard to leave. So when I got fired, it was such a blessing in disguise. So
yes.
If you're out there listening and maybe you do have a corporate job and you do have the juicy salary, just put some money aside. Put some money aside so that you have a cushion. And so when you get to that maybe 6, 9, or 12 months of expenses, that's a great time to give it a try. And you don't necessarily have to do what I did, which was kind of cold turkey. Like you can start, like if you're looking to get into real estate, you can start picking up rental properties or something, on evenings and weekends. You can start testing things out that way. So if you have a family at home, you obviously have to do the right thing for your family, and maybe quitting your lucrative job, might, without any savings and without any plan, is not what you want to do. So put some thought into it. Get around some smart people that may be doing things that you're interested in doing, that are entrepreneurial. I know in our area here outside Philadelphia, like there's a ton of real estate investor meetup groups that you can go and you can meet people who are super sharp. And I think that's where it starts. It's the people aspect. You got to get around the right people that are going to inspire you, and then set up yourself financially so that you can give yourself a runway. But just start. Just wherever you're at, just start. You got to do something.
Yeah, I like that, and most of the entrepreneurial stories that I know are ones more like yours. The guy's been thinking about it for a long time, and then circumstances forced him out of his comfort zone, and all of a sudden he's sitting here going, "Oh, I got to go do something." And the point that I think you're making, and that I always try to make, is y'all can get there on your own. You don't need to be fired or pushed out and put all that stress. But I don't know if that's it's very difficult to understand what you're capable of until you're forced to be that capable.
That's right. Yeah, what is it? Necessity is the mother of all invention.
That's right.
It's sort of a
Isn't
twist
that true?
on that.
Right.
You got to put yourself in that position where you got to make something happen. And you can just find a good niche, get some solid people around you, get the education, and you can make it happen.
Fantastic. Tom, this has been great. I really appreciate the perspective. That was fantastic. And I like the fact that we're able to get into the weeds a little bit, into the vernacular and the words and what these things means, because I always want people to know that whenever you go into deals, there are so many options available to you. That's just not go get a mortgage, as an example. And there's not just one option to you if you want to buy a business or any of the myriad of things. There's this whole kind of underground, I'll say, for lack of a better word, just not mainstream financing and access to money that doesn't involve you having it all and or being at the behest of the banks and all of the things that they do. So that's why I was excited to talk to you about this, because I think that this is kind of secret knowledge almost, even though it's so widespread. But I don't think the average entrepreneur, if we sat down with them and asked them all of the questions that I asked you, would have any idea what we're talking about.
Well, Jerry, you mentioned earlier in our talk about how the banks are really screwed up. Well, I think the educational system is really screwed up too, because these are things that people should be learning about. How to create a solid financial future for themselves and their family, and it's just not available out there unless you take steps of action on your own and you find the resources out there for if you want to get into real estate, go to those events. If you want to buy businesses, there's events for that. And so it's just it's unfortunate that you have to. It's not more prevalent. It's not packaged up and shared with our kids, but
almost like it's set up to just drive everybody to big banks.
Almost.
For everybody listening, you can learn more about Tom and his work. Go to eaglecapitalinvestments.com, and you can connect with him directly on LinkedIn under Tom Dunkel, Dunkel, at Eagle Capital Investments. And if you're interested in investing with him, absolutely, you can tell the guy knows what he's talking about, and any conversation is worth having. So, Tom, thanks again. I appreciate you coming on. Great conversation, man. Thank you.
Thank you, Jerry. And just a quick plug for my book. If you can go to my website, you can grab a copy of my book where I talk all about the different investment opportunities that I've seen out there, and tell some stories, and share my my proprietary due diligence method as well.
Go buy that book. Clearly, the guy knows what he's talking about. Tom, I appreciate it.